I just want to start by saying that this is a strategy that we're bringing up today because it's a type of strategy that we've seen the most traction with across Canada for the larger, higher net worth type of clients. It's something that is a great tool in the toolbox of many of our high net worth advisors and works largely in every province for multiple different types of clients. So I think having a type of strategy like this that we can roll out that'll fit in almost everyone's business practice is something very worth sharing. And then when I take a look at the stats of business owners in Canada, and it is, I should say, a strategy that only really targets businesses, we see a lot of room for opportunity here, right? So when we polled our businesses across Canada, and RBC's got a lot of pull this way, we saw that a lot of business owners don't even have a full wealth transfer plan set up. Surprising amount don't even have any preparations made at all. And only some even have a will. So really, the ball hasn't started rolling for a lot of business owners in Canada. And I think there's a lot of room for advisors to step in and start these conversations, start providing some guidance, and hopefully we can increase some of these statistics. You know, when I heard that only 45% of business owners plan to give their children more guidance on inheritance than they received, I was quite surprised. I would have thought that many business owners would want to continue that financial education piece with their beneficiaries, their children, their spouse, but that's simply not the case. So I think there's a market there for advisors to come in and help provide that guidance, work in concert with business owners and their children and families, and really increase the financial literacy in that market. So today, I'm going to first start with the agenda. First, we're going to talk about a little bit of tax, which is, I know, a lot of fun. Don't worry, we're not going to get too nitty-gritty into the tax side, but we do want to sort of set the stage for what's to come. We're going to talk very briefly about passive income and the small business deduction, again, chiefly to set the stage for what we need to know to have that conversation about the corporate estate transfer. Then we're going to talk a little bit about reducing taxable assets. Again, another stage-setting piece. And then we're going to dive into the corporately owned life insurance. There's quite a few portions of this plan, and we do want to provide a holistic look at it and really discuss each part of the plan. Finally, we're going to end with a case study. And don't worry, we're not going to have two 45-year-olds with two kids that are happily married necessarily. It's going to involve a little bit more of a realistic look, in my opinion, on a case study. It's going to involve a farming couple, right? It's going to involve estate equalization. And I think that this case study is more in line with what we have seen this year as far as where the corporate estate transfer has found traction. I can say we've closed quite a number of these cases this year and have consulted on quite a few. And I think this is where a lot of the business has landed on the prairie side, which is where I wholesale out of. There's a little disclaimer here. I'll leave that up for a few moments. And let's hop into it. So to begin with, let's talk a little bit about corporate income tax rates. So the following table here, it shows the general and small business corporate income tax rates federally and for each province and territory. What you'll notice is that the small business rates are the applicable rates after deducting the small business deduction. So I'm going to call that the SBD moving forward, right? Capital S, capital B, capital D. And it is available to Canadian-controlled private corporations. We're just going to call that CCPCs moving forward. It's easier for me. And the small business deduction rate is available on active business income. So that's really important to note. If you are taking notes, it's for active business income, up to the amount of the business limit. And I kind of put a capital B and a capital L there. So business limit. The federal business limit of $500,000 begins to be reduced when a CCPC's taxable capital reaches 10 million, and it's completely eliminated when that taxable capital reaches 15 million. So when we're looking at businesses in Canada, a lot of the small businesses that we run into as wholesalers and advisors are probably not going to hit that 10 million mark too soon. Or maybe they will if they're really taking off. But as a wholesaler, I see a lot of smaller companies setting up buy sells. You know, they're just getting started, so they're putting their insurance in place. And so we don't run into these quite as often. But when we do encounter a more mature business, this is something to take into account. It is absolutely not your job as an advisor to be a tax expert. You certainly have great resources that can help on this side, but it is good to know. So let's move on to take a look at how investments are taxed within the corp. And again, this is just setting the stage for later, but there's chiefly two layers of tax that as an advisor, you should at least be aware of and maybe even concerned about. So the first is the corporate level. So the the corporation is subject to annual tax on the interest and dividend income that it earns on traditional investment portfolio. So think seg funds, mutual funds. You can see the asset mix at the bottom here. We've just used an RBC corporate portfolio that's about balanced for this illustration. And what you'll see is if the client dumps in 60,000, they're going to have a respectable growth, and then they're going to have some tax payable, right? So that annual growth on the portfolio is not taxable unless it's realized or unless that investment is sold. The annual taxation does apply to interest, though, and dividend income and realized capital gains. So if you have something that pays you a bit of interest each year, you're going to have to pay tax on that each year. And so to that effect, when I look at this table, we're going to see that our balanced portfolio in this case has quite a lot of tax paid each year, so that by the end of the year, even though they will have done quite well and had a respectable return, it has been eroded quite a bit by taxation. Now, when the corporation then distributes its after-tax income to a shareholder, and this is the sort of second layer of tax you want to be concerned about. So the first is within the corp. The second is on distribution. So once we want to pay that to a shareholder as a taxable dividend, the shareholder then also incurs tax. The shareholder is taxed on the increase in the value, call that the capital gain, of his or her shares on the disposition or on death, unless a rollover is available. So when I look at this thing, really the takeaway in plain English is you're going to be taxed on the gains within the corp. And then if you want to pay it out, you're going to get taxed on the personal side. So just remember there's sort of two sides to taxation when we're talking about corporately owned investments. And it's that taxation piece that later on we'll address and we'll show some advantages of life insurance. And it's not surprisingly going to involve taxation. So what does it look like on an easy graph? What you'll see is that as the corp account sort of generates returns and rises over time, again, this is assuming you just get an average rate of return every year. If you were to pass away, because of the way taxation is going to come into effect, the actual net amount that we'll get to the estate at the end of the day gets cut down quite severely. And this, over time, tends to really, really grow. Now, not necessarily a really, really negative thing for a lot of clients. Many clients would look at this and go, okay, well, as bad as this is, at least somebody's making $4 million when I pass away. My kids will inherit $4 million. Job well done. And it's difficult to say that that isn't a job well done. But as an insurance advisor, we might be able to position a solution that will lead to more money going to the next layer. So whether that be the spouse, whether that be kids, whatever that next plan is. So passive income is a particular concern. Okay, so we look at active income as maybe something that the business earns, and passive income would be something like a GIC might generate passive income, right? Passive income can jeopardize the small business deduction. Okay, so the takeaways here is that a small business tax deduction is available to businesses with active income up to 500,000. So if you've got a relatively small business, you're kind of earning under 500,000, you're kind of mom and pop store, even up to some mid-size might even get up to around there, but up to 500,000. If your passive income exceeds 500,000, the small business deduction begins to decrease. And companies with passive income of over 150,000 annually lose the deduction entirely. So for small businesses, you don't really want to generate a lot of passive income if you can avoid it, because you don't want to jeopardize your small business deduction. That's the easy takeaway there. Now, when passive income, so for example, again, interest, dividends, taxable capital gains like rent, royalties, these are all examples of passive income. If the passive income of a small business corp exceeds 50,000 a year, its small business deduction is reduced by 5 times the excess. So for like every $1 of passive income in excess of 50,000, the small business deduction limit is reduced by $5. So for federal income tax purposes, the small business deduction limit is 500,000 per year. So if the corporation earns passive income of 150,000 or more for the year, it loses the entire small business deduction, and all of its active income is taxed at a higher corporate tax rate. So if you referred to that chart earlier, you'll sort of see what I mean there. The big takeaway, not to dive too deep onto the numbers here, but if you just want a general takeaway, you don't want to earn too much passive income in a small business. So as advisors, we need to think about how we can perhaps limit the passive income. And if you are a mutual fund license, or if you are familiar with mutual funds, it might be the case that certain funds will produce more passive income than others. So on the investment side, that's certainly a really large conversation to have, and probably a deep rabbit hole to go down as far as what investments to pick. But the broad rule, be a little wary of passive income. So what is our solution? Well, when I look at the larger investment portfolio that a corporation may have, we might look at using a permanent life insurance policy. Now, why is that? Well, the reason being that any gains within that, let's say a participating whole life, that won't be considered passive income. So if we're able to take some of their passive income and some of their active income and push that instead into a permanent life insurance policy, or money that's earmarked for passive income into a permanent life insurance policy, we might be able to reduce their risk of jeopardizing the small business deduction. There's a lot of other benefits to this, but for those sort of niche scenarios where we are in and around that jeopardy area, using a participating whole life is a really eloquent solution. Now, how do we reposition the assets? So this is a good example of what a typical case might look like on our side. So what we'll see here is an example of a corporate business owner or shareholders asset allocation and how this alternative tax deferral strategy may be able to add value to the business. So there is overall value to the business, right? There's real estate holdings. We've got probably investment properties, offices, businesses. There's a corporate portfolio. Sometimes there's real estate held personally. Often the shares of the opco are going to be in the holdco. They may have individual equities. I think now more than ever, business owners are interested in going on Google, quickly getting a PhD in how to invest through like a Robinhood or something like that, and doing their own equity investment. We do see that sometimes, this sort of self-directed stuff. So that's all fairly typical, but often corporate retained earnings are invested conservatively. We see that more commonly. So if they're doing conservative investing within their corp, typically what that will lead to is more passive income, right? So if you have a conservative portfolio that's mostly fixed income, that fixed income is mostly going to be paying out passive. And so now we have a little bit of a problem potentially. The other side of getting a lot of passive income is that it's taxed annually at a tax rate that's actually quite similar to the highest marginal personal tax rate. And as a note, that's because corps don't have graduated tax rates. They just have flat tax rates. So the tax side of corporate planning is quite heavy, as you'll see. But the big takeaway here is that when we look at a holding company, generally, they're going to have a plethora of assets. They're all spread out, and we may want to reposition some into insurance. So with this cute graphic that RBC's provided me, it's some kind of like an Erlenmeyer flask and a bunch of chemistry equipment. But really what we're looking at here is their portfolio, right? They're going to have some fixed income. They're going to have some equities, whether that's bundled into a SAG fund, a mutual fund, whether they hold them independently on their own. Whatever it may be, we want to purpose some towards life insurance, right? And again, the reason we want to use a permanent life insurance policy is because it allows for tax-deferred growth. It doesn't count as passive income. And this is governed by the limits allowed under the Income Tax Act. So, taking a look at this, let's start to contrast the two strategies. And by two strategies, I mean Option one is they just do investments. So they're only holding their seg funds or their mutual funds or whatever their current investment strategy is. And again, I know I mentioned this before, but I like to reiterate that oftentimes we run into folks who are a little bit more conservatively invested within their corp, or occasionally we run into people who have just done it all themselves, and that's that's a different can of worms. But what we're going to look at is option A. Effectively, they don't have a financial advisor. Pardon me. Option A is going to be our corporate wealth transfer, and option B is they're just doing it themselves. So option B, they're going to pay corporate tax each year, and when they die, there's going to be a huge deemed disposition. You might recall the graph, that big reduction. That's in part because of the big deemed disposition, and they're going to pay tax to take the dividend out as income. Or there's a deemed disposition at death, and we pay capital gains tax when the shares are transferred to heirs. We'll get more into that later. But the other scenario, which is option A, and we're going to call it option A because I think it's better than option B, we're going to look at using life insurance. Okay, so during the lifetime, rather than pay tax each year, if we were to look at a par whole life, for instance, the transfer to a tax-exempt life insurance policy is going to give us some really tangible benefits on that annual taxation. And at time of death is where things get really, really good with this strategy. Now, this is a good time to tell you that the corporate estate transfer strategy is really to move assets or cash out of a corp at time of death in a more efficient way. So that's where the CDA is going to come in. And for both A and B, we're going to be contrasting them as if the client has passed away, right? It's a life insurance strategy, so death kind of tends to be part of it. To start, I like getting this slide in here. I've kind of spliced this in a little bit early, but it's a cautionary tale in brief. A lot of corporate planning that we do, I've seen this kind of done wrong. I shouldn't say wrong, but maybe it's done with good intentions, but may not yield the best result. I just want to make sure that when we do set up these plans, we have the owner, beneficiary, and payor all as the corp. From time to time, what we've seen is like the owner being the corp, the payor being the corp, which is great, but the beneficiary might be listed as the kids. And I know that that's done with good intention, but CRA may not necessarily view that so favorably. And there's been a couple of recent court cases where that has come up. It has been challenged, and it did not go in the client's favor. Now, as this slide is alluding to, what we want to do is set a life insurance policy up. Again, owner, corp, beneficiary, corp, payor, corp. And if we set that up right, at time of death, we're going to receive what's called a CDA to the corp. And this is where things start to get good. So the CDA accumulates the non-taxable / non-allowable portion of capital gains and capital losses, and it's reduced by non-allowable portion of capital losses. You don't need to know that. I wouldn't take note on that. But what it does effectively is it allows you to pay out tax-free, effectively flow cash out of your corp tax-free to a resident Canadian shareholder. That's really important. Now, I get a lot of questions about CDA in my role, and I wanted to talk a little bit more about how the CDA can be affected, because it's not only credited by life insurance. A lot of advisors kind of get that mixed up at times, where they're like, okay, well, CDA comes from life insurance, and that's kind of where the LOQP ends. It doesn't talk too much more about CDA. It can also be like the CDA can be reduced as well. So it can be reduced by allowable capital losses realized by the corp. And because the CDA can be reduced by that, I've often heard it said that, well, if you get CDA from life insurance, you can sit on the CDA for a while and use it as you see fit, which is absolutely true. But in my mind, it might be better to use it while you have it, because if it gets reduced, that's not fantastic. If you got it available, I highly recommend to use it while you have it. And it is increased by any capital dividend, of course, received, but it can also be increased by a number of other ways. So as an advisor, you probably don't need to know the ways like through and through every which way, but it is important to know that it can be altered. So even if the life insurance gets paid out and they say, great, your CDA is 1.23 million or something like that, it's not going to be frozen at 1.23 million. So taking your time to work with it isn't always in the client's best interest. Now let's dive into the strategy. So we've set the stage with a little bit of preamble on tax. And now let's talk about what the actual corporate estate transfer strategy is. Again, we've kind of got situation A and B here. Situation A, again, that's our life insurance strategy. And situation B is just our no insurance, do it ourselves kind of strategy. So with situation A, what we're looking to do is take our annual surplus, a portion of it, and perhaps some existing non-registered investments, and we're going to push those into a life insurance policy. The idea here being, again, it's not going to create any passive income. And at death, we're going to get a big CDA, right? And that's going to allow us to flow out some of that, or in fact, typically most of that death benefit tax-free to a Canadian resident shareholder. And it is important to note it's got to be a Canadian resident shareholder. Sometimes we have people who are non-resident. That can cause some problems. Now, to contrast that against our other plan for the third time, we're doing an annual surplus that's strictly being invested in whatever it may be, mutual funds, equities, generally just non-registered investments. And we're going to have a huge tax bill at death. That's the big takeaway. One, huge tax bill, life insurance, because of the CDA, a fairly tax-free payout. Don't worry, we'll look at some actual numbers there in a bit. So here, the heirs, again, I'm going to lean on this a little harder. The heirs need to be shareholders to receive a dividend. So if we set up a corporate estate transfer and we, at the time of death of the owner of the corp, we want that death benefit to go to their kids or wife, whatever the next phase may be, those individuals need to be shareholders. So that does create a little bit of a job for non-advisors to go in and make sure that shares are issued and that there is a proper succession plan set up. So there'll be some work probably with the client's accountant and possibly their lawyer as well. The strategy, it does work, and it's super popular for corps and individuals right now, again. But it works especially well in corporations as a corporately owned life insurance that provides a conduit through which business owners can transfer retained earnings. Okay, then this little flow chart here, if you're a visual learner, might help you, right? Death benefit goes to the corp, then we pay out a dividend through the CDA, and it goes to the heirs and shareholders. So if you're a visual learner, that's kind of the flow that we're looking at. Now, when we try to apply this strategy, there's going to be a tax-deferred growth on policy cash values, meaning that at time of death, you're not typically going to get the full death benefit as equivalent to the CDA. So there's still going to be a little bit of tax that you end up paying. It's pretty nominal, but there will be a bit. If you're interested in how this is calculated, it's pretty simple. You take the death benefit and you minus the ACB, but don't worry, you will never need to calculate that yourself. Every insurance carrier will calculate that for you. And while you're alive, now this is sort of a brief aside. If you do set something like this up and you do have a nice par policy in the corp and it's being funded well and you've sort of earmarked this policy for a corporate estate transfer, we want to get the cash to the heirs involved. There are ways to access the cash value of the par policy, right? That in and of itself probably deserves an hour and a half webinar just to talk about. But for the clients who are curious, and when they look at the illustration, they're going to see all this cash growing inside of it. And they may ask, well, hey, how can I access this cash? There's quite a few ways. I think there's kind of three main ways, and they're not all equal. And not surprisingly, there are some tax advantages and disadvantages to each method. But for the time being and for the purposes of today, let's just note that it is possible to access that cash while you are alive and that it can be used as collateral as well. The tax saving potentials, this is where it gets good in my mind. So, of course, we have the tax preferred growth. And when we're accessing cash in the policy, if it's done through a collateral loan, let's just say, and again, but I should put an asterisk on that because collateral loans are often spoken about, seldomly done, and there's a lot of tape surrounding them. Typically in a presentation like this, I'll ask of a room of advisors, who here has actually secured a collateral loan on a par policy? And it's generally a fairly low number. I might get one or two, sometimes I would say just a couple percent. It's quite rare to see them done. There's a lot of red tape, but if you can get it done, there's quite a few tax advantages. Number one, if you can access the cash through collateral loan and you use that loan to reinvest and have a reasonable expectation of earning an income from that investment, you could potentially write off the interest, which is very nice. The actual loan itself is not taxed, so you could access a very large amount of that cash value without paying any upfront tax, which is also quite nice. And on the other hand, at death, because of the CDA, we get to withdraw most of that tax out of the corp tax, most of the death benefit tax free out of the corp. So there's some tax savings across the board, right? Again, we're skipping annual taxation too. So 3 big tax savings. And when I look at this from like a step back perspective, the tax side of par whole life is quite kind, because if we want to do something like a collateral loan, for instance, we can save maybe a fairly healthy amount that we would otherwise have to pay if we did a policy loan in taxation. So there's certainly a better way to do it. I tend to prefer collateral loan over policy loan. But it's not just tax efficient. The first point's really big, and in joint work, I talk about this a lot, because if you think about scenario A and B again, if we do scenario B where we're just investing and your client happens to die after 3 years, if you did a really amazing job picking funds and the portfolio managers did an amazing job managing those funds, you might expect a return of, let's use something generous, like 10% a year, compounded for 3 years. That's a really great return. And I'm sure that the heirs who receive that money would be really happy. But if you were to have instead taken just a portion of that and put it towards life insurance, and the client passes away early, the increase to the estate value is tremendous. It's exponentially higher than a 10% rate of return. So it's a great hedge against early death from an investment standpoint. The policy dividends aren't taxed each year, which is wonderful. And this third point, I don't think is spoken about often enough, but for those who are familiar with investment planning, something that you may look at is the standard deviation of an investment. So in a plain English, how much does it go up? How much does it go down? Like, how much risk does this investment have? Par policies at all carriers, right? So I mean, like a Canada Life, a Sun Life, a Manulife, like great companies, they tend to have a lower standard deviation than even like a T-bill. They're super, super conservative. They are very stable. And if you include par as part of their overall portfolio, it really brings that sort of standard deviation down. It's an extremely stable investment. And as a result, it can be very appealing for a lot of business owners who are already leaning towards conservative investments. The fourth point here, cash value that can be accessed tax efficiently via collat loan. It is tax efficient, but I do want to talk about this in very brief, because we do run into questions around collateral loans quite often. And if you're looking at like an IFA, it can be quite challenging to qualify for a collateral loan up front if the policy is too small. But for something like a corporate estate transfer, where we've built up cash for quite a long time, generally speaking, before we want to access it, it's much easier to qualify for a collateral loan. So you may hear that IFAs are difficult or challenging. I've recently dealt with a case that was declined collateral lending upfront because the premium didn't meet the lender's requirement. And that requirement was a minimum of $250,000 in the very first year of premium. So quite a large policy. And they said, nope, we want at least $250,000 in the first year. So for that IFA, that was a no-go with that particular lender. But with a corporate estate transfer, where you've built up the par whole life for many, many years, wonderful. It's actually quite a bit easier to qualify. And the reason for that is because lenders are really looking for sort of two main things, right? They're looking for security of the loan, which in this case, it's secured by the par policy. And two, they're looking for ability to pay. And if you can pay a premium, You might do some financial underwriting, but there's a pretty good chance that you could pay the interest on the loan as well. So lenders quite like collateral loans on PARs that have been involved in a CET. And the last point here, of course, the CDA credit does improve the estate value. Why consider it? These are the questions that my team has put together to address some of the needs that business owners have come forward with, right? So first point being, you want to create or protect an estate. If you've got a successful business, the CET is a great way to perhaps create an estate, or if you harken back to one of the first slides of this deck, many of them don't even have a plan yet as to how to transfer their cash out of their corporation. So this might be the first step. The second thing we see CET used for quite often is to fund an eventual tax bill, right? The third, and that's in blue because we're going to talk about this in a case study, it is to equalize an estate. The fourth, this is a little bit more niche again, but if you're looking at perhaps jeopardizing your small business deduction, we could potentially get some tax-exempt growth to support the retirement and pension goal. Could be quite nice, especially that tax-exempt portion of that. To fund a buy-sell. It's a little bit more rare, if I'm being frank. I think that we see a lot more term insurance used for buy-sells than we do par whole lives. Where we think it might be possible could be at an advanced stage of the business where they're looking not just to fund the buy-sell, but also potentially use it as another asset class for the corp. But it is absolutely possible. And if there is any potential for them to want to do a little bit more advanced planning with a par whole life in the future, picking the right term insurance is important on a buy sell. Really carefully take a look at the conversion options available, what the rules are around converting to whole life, etc. There are also some wonderful products out there at other carriers on the term side that address an increasing value of a business. So that's a plug for some of the other carriers out there. It's a wonderful feature that you can use. Sometimes we see it for key employee. This can be tricky though. It is a benefit, absolutely. But if you want to put a par whole life in place to protect a key employee and that employee wants to leave and you want to include that as part of their kind of exit package, you're definitely going to need an accountant to help with that. And in some cases, you may need an actuary as well. So par whole life is like a benefit for somebody or to protect a key employee. That's almost certainly going to come hand in hand with a little bit of tax work down the line. Asset preservation and wealth transfer, that's the main one, right? We want to transfer wealth. I don't think much more needs to be said on that. Business loans and long-term leases. That's an interesting one to me. I haven't run into this too frequently with par. I think we run into this a lot more frequently with term insurance, frankly, where as the terms of the loan, they may require life insurance as a form of security so that if something happens to the business owner, the lender is made whole. To use par for that, I would highly, highly recommend working with your resources available through your MGA to ensure that the way your beneficiaries are set up on this are done correctly. That one can be a bit dicey with par whole life at times. So this next slide, I really like this because business owners have multiple options when it comes time to transfer their business. And this isn't spoken about often enough. But if I've got a successful business, when it comes, towards the end of my working years, I kind of have three options, maybe a fourth one we won't talk about here, but the first that we see, particularly in the prairies, and as it pertains to the case study coming up, it's going to be to pass on my business to the next generation. So typically as a wholesaler and as an advisor, we want to make sure that the next generation is actually capable. There's not a whole lot you can do to say, hey, actually, I don't think your son is very good at farming. You probably shouldn't do this. But it is sort of a requirement that the next generation is capable enough to run this business, I would think. There, you also want to have a good long-term outlook. So if your business is sort of tanking and the next generation's already working in it, to take a look at the long-term outlook of that business and say, yeah, we want to pass that on to the next generation. Is that a good move? Do you want to pass on a failing business to the next generation? Maybe not. Sometimes it is the case, but that might not necessarily be a great gift. We certainly want to make sure as well that the retirement is secure. And if I could bold and underline this, that is something that I think a lot of financial planning software, at least when I was in the field, used to get kind of wrong. Is they would say, okay, well, the business is valued at this much, and so we're going to use that to help support our retirement. Well, if you pass it along and you just sort of do it without working with professionals, it may be the case that your retirement is no longer secure. Like, we need to ensure as advisors, accountants, lawyers who are involved that if you want to pass the business on to the next generation, that that G1 generation needs to ensure that their retirement is secure. We could talk about that more if you like privately, but that is a huge thing to consider. The last point here is that a lot of folks will say, oh, well, I'm just going to sell my business later. That's actually quite hard to do sometimes. To find a buyer for some businesses can take a long time. And you may be waiting for a number of years before you find a buyer, and they may not want to buy at the price you want to sell. So it can be really challenging to sell a business. So passing it on to the next generation is quite a nice solution, which is a great segue to selling to a non-family buyer. If the next generation is not interested, and anyone here who has worked with farmer clients certainly is familiar with this, where you may have a number or all, rarely all, but sometimes all, the kids who are just not interested. Like, they don't want the family farm. There's an uncertain future as well. If you sell to a non-family buyer, you don't know what they're going to do with your business necessarily. And retirement financially can be at risk if it's passed on to the next generation. So selling for some folks is going to make a lot more sense. Sometimes there's a hybrid. We don't run into this as often as wholesalers. It's not necessarily my role to get involved in a hybrid situation, but it's important to know as advisors. So the hybrid situation might be a case where the next generation is quite capable, and maybe there's multiple capable sons or daughters, and the business is too large to risk, and you've already got capable management that's involved, and that capable management might have been working for 4, 5, 20, 30 years in that business, and now they want to take on some ownership too, because they understand the business really well, as do the children. So in some cases, we may want to give a portion of ownership to these well-deserving employees, and that's kind of where corporate estate transfer can help. So let's take a look at this case study. We've got two 60-year-olds, so already a little bit older than the average case study that I see. Usually they're like both 45. They have 2 adult children, right? Their land is valued at $5 million. Now in BC, that's probably light. I know that there's a farm that's for sale down the road from where I live right now, and that land I think was listed at 10.5 million. Through their operations and their corporate portfolio, we've got about another 5 million just in value here. Okay, we won't get too gritty on the details here, but let's assume that Michael works on the farm, okay, and Sarah is a teacher. So they all have a good relationship. It's just Sarah's not really a farmer by trade, but the family is harmonious. So the parents, in their wisdom, they want to treat the kids fairly. And by fairly, what they mean is equally, because fair and equal are not always the same thing, but in this case, they want to be equal. So they realize that the land value, it is what it is. It's quite high. And their son continues to contribute to the land and improve upon it and grow their business. He's young, and they realize that to give half the land to Sarah is probably not going to be fantastic. So on their passing, they really don't want Sarah to impede Michael's ability to manage the farm, and they do want to acknowledge his contribution to the operations. So from a tax perspective, the farm can roll over to either or both children, but the plan is to leave the farm to Michael. I mean, he's working on it. And instead, we're going to provide Sarah with insurance as an alternative. Now, just as an asterisk, she's not going to be the life insured, but we are going to use a CET, a corporate estate transfer, to address Sarah's portion of this. So how do we construct it? Well, what we're going to do is we're going to have a joint last to die, right? Because we know that this is a final expense issue. And we're going to have both Robert and Susan with coverage of 5 million, and we're going to use participating whole life. This is what it would look like on our illustration software. And what you might notice first off, this is a bit of a plug for the RBC product here, but the joint insurance age is only 49, meaning we view two 60-year-olds as if they're 49 for the purposes of determining their premium, which is quite competitive in the market. Maybe more on that later, but RBC tends to be quite good for joint equivalent ages or joints standard ages. The premium is a little hefty, right? 116,000 per year. And what does that look like from a value standpoint? Well, we know that the death benefit is going to be increasing quite nicely. And in and around average life expectancy, right, we're going to see that the total death benefit is around 6.8 million. Right around there. Could be a little north, right? One thing that I'll often say about these illustrations is they're never correct. The dividend will change every single year. And while some companies may be better some years, others are going to have their time in the sun, and so on and so forth. Generally speaking, people own a par policy multiply longer than their first home. So if you do pick up a par policy, have an eye for the long term, and don't be too caught up in what necessarily the dividend is today. So looking at this, pardon me, let's compare it to our scenario A and our scenario B again. So we've discussed that we would like to use insurance to address this need, which is equalizing the estate. And we want to show the client that if they just do their own investing, kind of what would the expectation be with the same dollars? And then we'll contrast it to what we could do with participating whole life. So we know that the premium that we calculated was 116,465. So for this first scenario, which is going to be just investing, no insurance at all, let's pretend that we take that same amount that we would have put into premium, and instead we'll put it into an investment. We're going to use the RBC Select Balanced again, just for ease of my life so that I don't need to keep picking new funds. So it's going into a taxable investment. And we know that each year that's going to kick out some corporate tax on the investment earnings. And let's assume that they die at the age of 85. Okay, so they die at 85. And this is the amount that they would have to pay dividends out. Okay, but before we get that amount, we know that we have to pay tax on any deferred capital gains. So for instance, anything that they bought and have not yet sold. We know that based on the math, again, it's just averages, but we would think they'd have about 3.75 million, which is awesome. Like most clients would go, wow, that's amazing. I could leave Sarah 3.75 million. And that's pretty great. And if I were Sarah, I would agree. I would love a check for 3.75 million. But that's not what's actually going to happen, because this is just what's happening within their corp. What happens next is they need to pay personal tax on that dividend received. And so that the after-tax value of the dividend that goes to Sarah is reduced to 2.932. So she's paid about 800,000 in tax on her inheritance. It's quite a hefty amount to lose. This is a really good option if you love the CRA and you'd like to fund them and continue their great works. That's wonderful. But we could probably do a bit better. We might be able to keep more cash in the family. So let's look at the scenario B. All right, so scenario B, we're going to take the same 116,000, okay, and we're going to throw it into a par policy. There's no corporate tax on the accumulated growth, so that we know, we've gone over that. And they die at 85, same as the other scenario. So far, the only difference is the tax, which we've discussed at length. And there's going to be no corporate tax on the death benefit, so they'll get a check for the full amount, all right? Based on the illustration, we think that's going to be about 6.9 million, assuming our dividend stays at 6%, which I guarantee that for 40 years, it definitely won't. It'll go up or down. But the CDA is going to kick in, and that's going to let us move tax-free 4.8 million. There's no personal tax paid on that. There is going to be personal tax on the dividend, so the difference between 4.8 and 6.8, there's going to be some tax there. But what she's going to get to keep is 5.9 million. So when I compare the two, the corporate estate transfer is going to make those clients an extra $3 million. As an advisor, to be able to take the same premium dollars and show that kind of value, if it takes you 10 hours to do this, you're basically valued at $300,000 an hour. That's a huge deal for most clients. And as much as I would love to receive that 2.9 million, receiving 5.9 million is quite nice. I'm not going to talk about life insurance shares in the interest of time, but I will talk briefly about where our product makes sense in this market and why I'm even presenting on this. So RBC, we do have a really comprehensive offering of products, but I want to make it pretty clear where our product is the most competitive unto itself. So where I think our product is the most competitive is going to be between ages 40 and 50. I know it says 35 to 55, and that is true. I really think we shine age 40 to 50 on 20 pays and life pays. That's where we do really, really well. In particular, our competitive joint ages stand out to me, meaning for any joints first to die or joint last to die cases, extremely competitive. And on the cash flow side, so if you're looking for early cash values for an IFA, for any early lending strategies, for any early cash value strategies, that is where our product shines, in particular, ages 40 to 50. Now, the other place that I like our product is with ADO, additional deposits. Ours is entirely flexible. Our first premium sets the room, and you can always go up to that amount, decrease it, meet in the middle. I think this bar graph shows a pretty good representation of how our ADO can work. Provided the base premium is being paid, you can always fluctuate that additional amount. It's a little bit more similar to a UL in terms of that flexibility. I think a lot of carriers are moving in that direction or have already arrived, which is great news for the Canadian marketplace. Some numbers behind it. Now, I've cherry picked this client really carefully so that you see really favorable numbers for RBC here. Again, the client's 45, so he's right in the middle of our target demographic of 40 to 50, right? If I change that, I'm sure some of the other companies are going to look really, really, really good. But for somebody 40 to 50, what you'll see is that the cash surrender value in the first 10 years is really strong. What you'll also see is that on the base coverage side, we tend to have less death benefit, but a lot more cash value. So for corporations that are looking for a cash value rich strategy or individuals looking for a cash value rich product, our product tends to look really good. And when I take a look at the dividend of some of the other carriers right now, ours is at 6. Quite a few are north of 6, but we're still able to hold our ground in the first 10 years based on the merit of the product. The other 3 things that I like to bring up on the product side, I'm a bit of a math nerd, is I like to look at the internal rate of return on cash value. So how does it work as an investment vehicle? Most carriers are very, very similar here, but I think that given our lower dividend this year, it does go to show excellent. Our total death benefit, everyone is within a couple percentile of each other. And this is a point I wanted to make, that from a death benefit standpoint, every carrier is working in the same framework. Tax law, the same population. We're all competitive against one another. And I think what you'll see at the end is we're all very similar. CDA is also the last consideration. We have, as a company, virtually every offering that an advisor could need at this point in time, right? So on the life side, RBC's now got term, UL. On conversion, we have par whole life. We have a wonderful disability suite and CI. And on the wealth side, we have seg funds and payout annuities. We've seen a really big surge in the popularity of annuities with rising interest rates. So for those who are interested in annuities, RBC might be a good place to take a look at, if not quote. We have a wonderful sales resource center that has product information, case studies, underwriting guidelines. It has a lot of resources available to you. If you would like to scan the code, that will hyperlink you right there, right now. So you can bookmark it. That way I don't need to send out mass email with a link. I know that was the way of the past. And now we have these wonderful QR codes. We also have I know a wonderful photo of Mitch here for those who know him, but we've also recently launched our estate and tax team. And I wanted to put in a few kind words here as an add value. Our tax and estate team consists of a lawyer, a number of CPAs, product experts as well. And should you ever want to discuss a case, an active case with RBC, in-force case with RBC, in a bit more depth, involving the tax or legal side, we're here to support you in whatever way that we can. You've got excellent resources at your MGA to take advantage of, but at times you may want to work with the carrier company too. And in that case, we have a really well-experienced squad. They're based out of Toronto, but we're happy to book a half an hour to sit with you and just talk the case over. We're happy as well to sit with you and the clients. If that's more to your liking, we can provide that service as well. There's no reduction in any sort of like comp. We don't bill you by the hour or anything like that. We're just here to support you genuinely. So in summary, with a corporate estate transfer, we're looking to reallocate a portion of surplus to a tax-exempt environment, right? Which would be the par whole life. The taxable investments may need to be repositioned into a life insurance policy. And if they do that, it's going to immediately increase the cash available to your heirs if you pass away tomorrow, right? So it's an immediate hedge against early death, which is really important, like in an instance like our case study. But it's also pretty important for most business owners who have heirs, period. Most of them will want to pass it along in an efficient way. And frankly, most business owners love to save on tax. So if the benefit is we can do this more tax efficiently, great. It tends to also make a lot of sense to their accountants, right? Because we are dealing in their realm. And the tax savings that come with a CDA, I think, are far in excess of any potential gains you could get in like a scenario B where you're just investing. A corporate business owner can reduce the current and future corporate tax. Talked about that all day. And funds can be flowed out with the CDA, right? Here are the contact information for all of our life wholesalers across Canada right now. So in BC, we have Lorenzo Mercado and Ling. In the GTA area, we've got Anna Sapellis. In Quebec and Atlantic, if anyone on this call is there, we have Steve Caron. Right now, I am looking after the most of the prairies. So Alberta, Saskatchewan, Manitoba. If you're in Thunder Bay, I've got you there. And if you're listening in from the Northwest Territories, I'm here for you. In the Waterloo, Kitchener, Northern Ontario, we have Wilson Huang. And in Ottawa, we have the newest member of our six-person cross-Canada team, who is Nelson Pride. Equitable Life should be on this comparison. Absolutely. I think we could like bulk that out with probably 4 or 5 more carriers to really have like a true cross-section of where all the values are. Absolutely. So to the individual who said that, I think we could certainly bulk that slide out. It's something that as a broker, I know, having been a broker of par, it's something that is frustrating is there's so many carriers, where does everyone shine? I wanted to put up that slide mostly with a focus on those carriers who aren't labeled. I didn't want to label any of them, but I wanted to label the ones who've been in the market for quite a long time with a really proven history. Equitable certainly belongs on that slide. Can the life insurance premium be expensed and still have the death benefit? If you expense a life insurance premium in its entirety, you can certainly run into some problems. So there's sort of the guiding principle that I would give you is no. So you don't really want to expense it because it could cause the death benefit to become fully taxable, which is the easiest, simplest, most straightforward reason not to do it. In some circumstances involving lending, you may be able to expense a portion of it. We won't probably get into that in the 2 minutes I have, but as a general guideline, you don't want to expense the life insurance premium. Let's see here. I think that's pretty well it, unless anyone else had any other questions, and we're like right on the hour.